Well, hello, everybody. Steven Sitkowski here. Welcome to my Market Insights. It is November the 10th, my sister's birthday. So as soon as I'm done recording this, I have a phone call to make. Anyway, I hope you are all well. We've got some positive impetus in the market. That's a big word, huh? Hopefully I used it correct. I was afraid I would, mix that up with something else, but I didn't. Quick reminder that everything that we do here is for educational purposes only, not intended as investment advice. So let's move in the markets. Well, it looks like the government shutdown is going to end shortly. So it's driving stock prices higher, it's driving everything higher. Bitcoin's rallying, gold's up 2%. So, we've gone from woe is me to now suddenly everybody's pretty happy about things. I don't know if we operate better when the government's open or closed, but there will be a lot of people that rely on those checks. They're going to be relieved, and I'm happy for them. 10-year Treasury pretty stable at 4.108. Anything around 4% is a nice rate of interest as it relates to stocks. And oil prices, they're hanging in there around 60. Not much to report there. So, we had this little um, dip in the market the last couple of weeks, and I just wanted to give you some perspective on things. So, how often in a typical year do we get a 3% dip? 7.2 times. How about a 5% dip? About 3.5 times. How about a correction of 10%? Typically once. We've had one of those this year. 15% happens about every other year. 20% happens every 3.5 years. But these dips, they're part of the deal, gang. And it's why we don't panic. We look to see if there's a systemic issue, which could lead to further decline. And in this case, there really wasn't any. There was talk that AI stocks were overvalued and we had the government shutdown. And the way that we sort of looked at that, corporate earnings are still great. Over 80% of S&P 500 companies beat earnings during the earnings season. So all that's great. Couple that with the fact the Fed's going to lower rates again, probably in December. And we knew the government would get back to work. So all of those were going to be positive stimuli. That's what we bet on, and that's what's happening. Market breadth for last week was kind of sucky. Wasn't horrible. It was worse on the NASDAQ stocks. So, on the New York Stock Exchange, yeah, there were more decliners than advancers, but there were only slightly more new 52-week lows compared to 52-week highs. But over here on the NASDAQ, 608 new lows, 345 new highs. So those are the more, go-go stocks. And also you look at advancers versus decliners. So just generally, it was in much worse shape. But we're off to a really nice start, this week. So all good for that. Year-to-date returns are still incredibly impressive. I mean, the Nasdaq was down 3%, but it's still up 19% for the year. S&P 14.4, the Dow up double digits at 10.4. Last week, heat map littered with stocks that were lower, some significantly lower over here on the tech side. Now, consumer defensive, fine. REITs, utilities, fine. Health. So those are the defensive areas. The more offensive areas were the ones that we found in red. The big winners, most of this is all earnings driven. Kenvue, up 17%, Datadog 17%, Expedia 17%, popular number, Harry Sheen 13, Insight 13, uh, Expeditors International 12, IDEX same, Coterra same, Steris and Marriott, yeah, all earnings driven. But it has been all about the Magnificent Seven going back to 2019. I mean, here, that's a Magnificent Seven. Here's everything else, right? That is the S&P 500 minus those seven stocks. So if you didn't own those and have exposure, chances are you haven't done much return-wise. Market sentiment has dropped off a little bit from the previous week. So the bulls have gone from 44 to 38%. The bears have stayed right at about 36%. So I'll tell you, I'm a bull at this point. Stocks trading above their 50-day moving average. I mean, you can definitely see, I mean, we could do a trend line. It's down, and now we're well below that. So we're at 44% of the stocks trading above their 50-day. You know, to be considered bullish, it's got to be over 50%. Maybe by the end of the day or the end of the week, we'll be back there. Consumer sentiment has just tanked. People are feeling crappy. I think a lot of that had to do with government shutdown, frankly. You know, people feeling if the government can't handle their business, you know, why should the average person be expected to handle their business? So you could see it is the lowest that we have had in a long time. Hope none of you feel that way. Let's take a look at the charts. The charts always give us perspective. That's why I tell people, when in doubt, look at the charts. Here's the SPX. And this is a 6-month chart. And look at how this 50-day, which has been sloping up, that's the yellow line, has held, including this last dip. It just went boing right off of that 50-day moving average. What about the triple Qs? I haven't looked at those in a bit. So this is the NASDAQ 100 Trust. Yeah, did exactly the same thing. You got that long tail. So there was some buying toward the end of the day, and now follow through today. So everything's okay, right? We want to avoid panic at all time, at all costs. And the way to do that, like I said, just go look at a chart. You know, if there's a reason to panic, you'll see it in the chart. Otherwise, just assume life's okay. You know, when you see a 50-day moving average that's sloping up and the pricing is above that, we're all good, at least for today. Now, if we get some negative news on the you know, shutdown, could be a different deal. Anyway, hope you have a fantastic week. I'll be back with you again next week. Until then, be safe, be blessed, and bye for now.